Hey, before we get started, I want to talk to you a little bit about our theme for this quarter, growing and protecting your portfolio. We're excited about various topics centered around this, but it really comes down to three concepts that will help you grow and protect your portfolio. You can find a PDF on our website about this. Go to wiserinvestor.com, scroll down to the bottom, enter your email address, and you'll get the PDF titled 3 Ways to Grow and Protect Your Portfolio. Thanks for listening. Welcome to a Wiser Retirement Podcast, where we cover financial topics such as retirement planning, tax planning, portfolio management, insurance, estate planning, so you too can have a wiser retirement. I'm your host, Casey Smith. Guiding you to financial success are my co-hosts, Brad Lyons and Barnett. Hey, guys.
Hi, Casey.
How's it going?
Well, today we're going to pick up a topic that I don't know that most people would think about, but it's probably something they do all the time, which is compare, right? It's human nature. We want to know that we have the best or understand why we're losing and why we need to have something different. And, we see a lot of things. We have many people that come through our office, and occasionally, we focus on planning and educate on investing, because a lot of people have the wrong mindset on their portfolios and what they should be doing. Meaning a lot of people try to time the market, go to cash. It just doesn't work long term. So we have benchmarks internally, but if you're at home and you're looking at your own portfolio, what's the best way, do you guys think, to compare an investment portfolio versus something? For instance, if you have bonds in your portfolio and you're looking at your portfolio and you're comparing it to the S&P 500, that's not a fair assessment. Right?
Right.
And why is that, Brad? Well,
I like the way you ask a simple question, and it's really a very difficult answer.
I'm good at that.
Yeah. Because you're right, we do compare. We want to know how we're doing relative to how well we need to be doing, which is often an unknown in and of itself. But we want to know that we're doing the best we can under the circumstances. Right. And so we often hear from clients saying, well, my portfolio's doing X. And without having a context around that, X doesn't really mean very much.
Right.
Matthews and I were talking, and it's great if you say your portfolio returned 10%. Okay. But the market returned 20%. Okay. What does that mean?
Historically, that would have been good.
What does that mean to the investor? Okay, the 10 that they got versus the 20 that they may have gotten under a different portfolio scenario. Okay, now you're right in that depending upon the composition of the portfolio, it's not fair to judge one portfolio to another. It's like apples to oranges. You want to be able to compare apples to apples. So by being able to compare our portfolios or an investor's portfolio, it needs to be compared to something that's relevant, right? Okay. And there are a number of ways to do that out there. One is to pick a benchmark that is an index. Indexes are baskets of securities representing a broad portion of the marketplace. And you can pick one of those relative to your portfolio, as long as it's, as I use the word, relevant. It makes sense that your portfolio and that index have a relationship to one another. Okay? The other way to go about doing something this is determine something that we utilize here in our planning process, and that's determining, well, what's the required rate of return? What do I need to earn in order to achieve all the goals and objectives that I have for myself through my financial plan? Okay? And that takes a very long-term approach and look at a portfolio relative to its cash flows and the amount that it needs to grow over time in order to meet all those future liabilities. So as a required rate of return, that could be a benchmark as well. So there's different ways to do it. It depends on what you're trying to accomplish with your portfolio.
So through the planning process, it's, you come up with a need. So we're not going to plan anything much above 6%. rate of return, and you have to be pretty young even for the 6%. Hopefully you have something in the double digits if you're in your 20s, but reality is that we're not going to guarantee that, and the market isn't going to guarantee that either. So for most retirees, you're probably focused something around a 5% rate of return is what you're looking for in a portfolio. So, but you have to average that out, and the problem is that people don't think long term, and people don't. Whatever's happening now, it's like, in their portfolio, it's like it's always happened, and they tend not to look back either at historical performance of what they have done, right?
Right.
Well, it's been great the last 2 years. Anybody could have done well, and that's what we see a lot of people say, what have your portfolios done? Well, like you said, it's relative to what you're invested in, but even a 10% return historically would be great with the S&P 500, but over the last 2 years, it significantly underperformed it. So some clients that would brag about having 10% returns, it really wasn't that great. But historically, it would have been great, and it also depends on the risk tolerance and how that was invested. So there's a lot that goes into it.
Yeah, I mean, you met somebody who in the last years had a 30% rate of return, but they held 2 stocks. That's a lot of risk in 2 companies, right? And also, too, we're kind of on this growth high still. In the last year, growth versus value has equaled out. So
that's finally occurred.
Value stocks and growth stocks over the last year have basically the same rate of return. So that's as a group, obviously, inside the S&P 500, large cap size.
Well, risk is a word that you brought into the conversation that needs to be brought in because it's part of the overall performance of a portfolio and the way it's invested and the way it's, the composition of it. So you can't really talk about benchmarks and comparisons without talking about risk as well.
Right. So you have, we try to mitigate as much risk as possible. We eliminate company risk by essentially holding index funds.
Right. And what's left in the market is called systematic risk, which is the risk of the market.
Right. And the only way to get rid of that is to put it in your mattress, and then the inflation risk is going to come up and bite you in the rear end, right? So,
that's right.
So I guess, that's a good point. So let's introduce, something a simple risk measure would be standard deviation, right? Mm-hmm. Which is volatility. So if you have an average rate of return of 10% over the last year, but your volatility or your standard deviation was 20%, that's pretty high, right?
It is. That means your portfolio could have returned under different circumstances anywhere between negative 10
right.
and positive
30.
Thank you for the math.
So so that's kind of an extreme example, but that's one of the things that we'll look at in a portfolio when it comes in to under our care or we're talking to someone who wants their portfolio analyzed is, okay, well, your standard deviation was this. And then there's your Sharpe ratio. Sharpe ratio is able to measure is the additional risk that you're taking worth it, or did you just get lucky?
Right. Are you getting paid to take the risks that you're taking?
Exactly.
Yeah. In layman's terms. Yeah.
So and those Morningstar, I know their free service, I think even shows standard deviation Sharpe ratios right there on the screen. You probably have to pay for the premium service, where things like a few bucks a month, but you get a portfolio standard deviation and Sharpe ratio. That's what we look at quite a bit in our own models. Is are we getting paid for that additional risk? But when you're at home and you're looking at the TV and it says the market fell 800 points today, it's down 3%. That's the S&P 500 more than likely, or the Dow, and they sort of run together for the most part, unless there's an extreme disconnect, like Tesla. But outside of normally they kind of move together percentage wise. So if you're a 60-40 split, 60 stocks, 40 bonds, you didn't fall 3% today, or if you did, there's a problem, right?
Right.
So is a S&P 500 really a gauge for a 60-40 portfolio? It's not.
No, not for the entire portfolio, but it may be for the equity portion in the portfolio, depending upon the composition of it as well.
Correct.
Yeah.
So if you're going to use the S&P 500 as a benchmark, what you're going to have to do is peel away your fixed income
Right.
in your portfolio and then only look at the equities. I guess you'd include REITs in that. So if you have 40% in bonds, if you had a rate of return of 10% and 40% was still in bonds, I guess you get to add 40% to the rate of return. Is that right? Is that how you do that?
Something like that. It's just math.
So yeah, just remember that when you're comparing and when you're comparing portfolios, it's really hard to get apples to apples. Typically, you have to have some type of a benchmark portfolio. And here's how I like to think about it. If I did like a lazy person portfolio, I think that that's actually a thing. They have the lazy man portfolio. I think I've heard of that. I think someone told me about it one time. Basically, it's just passive index funds.
That would make sense.
So if I was just going to be super lazy about building an allocation, I really only need 2 indexes. The first one is the entire world in relation to its market cap size. So mostly it's U.S., but there's still a healthy allocation to foreign stock. So that's ACWI, right? Or FTSE and global index.
Right.
What's the ticker for that, for Vanguard? Is that VT?
VEU? VT?
I think it's VT.
VT.
Yeah, I think that's right.
Yeah.
So VT, Matthews, can you look that up? VT would be a fund that would represent the entire world.
Right.
So you could put that into, build your own portfolio. If you don't have any way to track individual indexes, it's really simple. Just type in VT and there's your equity for around the world.
VT, total world.
There you go. So that's representation of all stocks, emerging market, developed. There'd be default some REITs in there, but it's not overweight anything. It's just how it appears in the world. So there's a good basis for a portfolio, for an equity side of portfolio. The bond side is pretty simple. That's I would use BND. It's Vanguard's total U.S. Bond ETF. Mm-hmm. So that represents the U.S. bond aggregate. And so between those two funds, you can now develop your own benchmark.
Because what that does is it defines the playing field, the investable universe, which is all the equities in the world that are publicly traded that you as an investor could invest in if you want to take the time and energy and effort and all that. On the bond side, you're representing the largest bond market, fixed income market in the world with BND. Okay. Right. So you've defined the playing field. Now it's time to figure out how to actually invest your own money, utilizing that proportionality, equities to fixed income, to manage risk and to get the maximum return at any given level of risk, right?
Right.
Okay, so it doesn't necessarily mean that the portfolio is invested exactly the same as the benchmark or the index, okay? But what it does say is if I did nothing else, if I were the lazy man, okay, and invested in those two securities, I would have covered everything. Go off and live my best life, not worry about it.
So then the way that you try to beat that global index is you're going to overweight in certain asset classes.
Right. You're going to pick and choose markets, countries, regions, asset classes, industries, sectors, etc., in order to try and do better than the benchmark.
Correct.
If that were the case. Yeah.
So, yeah. But basically, if you're at a brokerage firm and you're looking at a smorgasbord of, Lord Abbott, American funds, all the most expensive funds out there, and you're wondering, after fees, am I even keeping up with anything? Right? That's a great way to do a comparison. Just go build a portfolio, and then look at this rate of return and look at your portfolio's rate of return.
Yeah, because most people are just going to check their statement to see the allocation of stock to bonds, and then look at the returns, and then so what?
It's based on how they feel,
right? Then
I feel like that's a good rate of return.
Yeah, it sounds good, but was it at that time, and what's going on with the market and the environment?
What's interesting is we use a similar concept to build benchmarks for ourselves to see how we're performing versus a benchmark, right? Mm-hmm. And we show that to clients on their quarterly newsletters or quarterly performance reports. What I find interesting is all the big brokerage houses, they don't ever show benchmarks to their clients. I find that interesting. Is that a compliance thing? Is it they're, or are they afraid that they're going to cause trouble or cause a ruckus because they're not performing?
Well,
because you think internally they'd have to have something.
Yes, it may be because
Maybe it's too complicated.
Not all brokers have discretion on the account. So, what do you think, Matthews?
I mean, they're not managing in-house portfolios like this. A lot of it's managed by investment offices in the firm. So, and there's a lot more diverse, different types of portfolios. So, it's probably the fact that it's not just one benchmark they could pick. It would end up being thousands of different various benchmarks that they would have to apply it to. So, it's a little different than what we do here.
That's true. Because if you get sold an annuity, how does that fall into investments? Is that
that's all
considered fixed income, or is that considered? Yeah. I don't know. The whole world just baffles me because everything's so transactional. Everything has to be a transaction. So there's really no in-depth planning, which means there's no benchmark ever established. So how do you know if you're keeping up with, your standard of living for the future?
Or as you said, if you're meeting your need, right?
Yeah, true. They probably don't even calculate the need.
Right. Okay.
Yeah.
And even if you're off by a small amount over long periods of time, that can have a devastating effect.
Oh yeah,
exactly.
Absolutely.
Yeah.
Think about 1% compounded over 2 decades.
Sure.
3 decades.
Doesn't sound like much.
It's hundreds of thousands.
That's real
of dollars.
money.
Right. Absolutely.
Mm-hmm.
Yeah. Well, I think that the whole point of this is, when you're comparing portfolio versus portfolio, maybe it's not versus a wiser portfolio. Maybe it's just your friend at the water cooler, right? Mm-hmm. You have to understand that risk and reward go hand in hand. There's no free lunch. The people that tell you can make the money on the way up, you can make money on the way down, make money no matter which way the market's going, are also people that like going to Vegas and like gambling because that's what it's doing. You have to. I can't imagine the anxiety of trying to figure out is today an up day or a down day.
Yeah.
Right. And that's how you have to plan it. Where we know that there's more up days and down days, so we're willing to absorb this market volatility that we're in now because we know long term we're going to win. Always have, as long as capitalism exists. I think we always will.
I think we've talked around the office quite a bit about the difference between an investor and a speculator. And what you just described is a speculator.
Right.
They're speculating from day to day, week to week, period to period, on whether the market's going to move up or down or sideways, depending upon how they perceive it at any given time. And the skill set to do that is extraordinary.
Oh, yeah.
Yeah. And there are very few people who have it. Because theoretically, if you had it, that's what you would do, and you'd be on your yacht, in 2 years.
Right. Well, we see that in the statistics. So even professional fund managers, they paid millions and millions of dollars a year. Mm-hmm. Only 6% of them have managed to beat the S&P over a 20-year period. So that's a very small percentage.
Right.
And a lot of them exit. They go to hedge funds or they go to private equity or somewhere else where their talents are even more paid off. They're getting 2% and 20% on the gains. So yeah, to me, it doesn't make much sense to hire an active manager for any strategy. I've seen the short-term benefits for sure. I've seen 2, 3, 4, even 5-year rate of returns that look really good, but you can't sustain that. Statistically, it's not possible to sustain that. So I'd rather be in a portfolio that costs me 0.05% a year, knowing that I'm going to make it and have a 94% chance of beating all the other people. Right.
Right.
And like you said, that's something we hadn't mentioned is the varying costs of the underlying portfolio, as well as we see a lot of people last year had big capital gains in December. So it's a good thing to have. It means the portfolio is doing well, but in brokerage accounts, a lot of these accounts with mutual funds had really big capital gains distributions that they hadn't accounted for.
Yeah, that's a good point. So you have your rate of return on paper, but then there's your real rate of return, which I don't think anybody really calculates. I can tell you a short story. So I bought this firm in 2007 from a guy named Mr. Weiser. And this firm, its roots back in the late 80s, this firm was a stock trading firm. And so he would buy and sell on a regular basis. And he had little old ladies paying thousands of dollars in quarterly tax estimates. But yet he was making money. So when I bought the firm, I knew that this is not the path that I wanted to go down, but I love the client base. I can't remember how many people were here at the very beginning, a fraction of what it is now. But I actually went through and calculated their taxes and related to capital gains, not income, just capital gains. And their rate of return came way down. You can make all these moves and do all these. He had option strategies. It was all kinds of stuff going on. But in the end, the S&P 500 beat his all stock portfolios. Why? Because the transactions and the cost and the taxes of doing that. Mm-hmm. And I remember sitting down. I said to sit down. There's about 60 people I met with in maybe 2-month time frame. It was a blitz of a 2-month period. And I said, look, I have a new concept, and that's simply going to be investing in index funds. We're going to buy mostly the S&P 500, and then we're going to build around that and diversify. And nobody objected. And then when the next year rolls around and they're like, I said, you don't have to pay your quarterly estimates anymore. And yet they had market-like returns, right? It's amazing what we have to do. What we think we have to do is protect practitioners to justify our fees, because people expect us to be doing things. We have to be doing things. What we have to be doing is monitoring and understanding what's happening in the marketplace, and are there any roadblocks? But we don't have to make trades to justify anything. In fact, I would say if you're making too many trades, you're hurting the client, even though they might be feeling better. And so sometimes it's an interesting relationship. We have to do a lot of education as advisors. We should be doing a lot of education as advisors as to why we're doing what we're doing. But I feel like a lot of our industry doesn't seem to get that if there's a fire, we have to go put it out. And sometimes it's just better, just let the fire burn. You know,
you talk about, making trades in a portfolio in times of volatility. Sometimes the best thing to do, the most important thing to do, is to not do, right?
Yeah.
Unless the fundamentals of the marketplace have actually changed from the point in time that you made the original investment and the portfolio construction. But if the fundamentals remain the same, but there are exterior influences on the market, okay, the right thing to do is to do nothing.
Well, it's just like right now, at the time of this recording, we're going through this
exactly
Russian, Ukraine. Well, it's really Russia's war. No one else was looking for it. And we're not so much focused on that, are we?
No.
That's the dumpster fire.
Right.
But what we're more focused on is economic growth and inflation. And how does that affect the portfolios? And how does that change our thinking on anything regarding our portfolios? And the reality is right now, the best thing to do is double check your allocations, make sure that you're allocated the way you're supposed to be. But the big fallout in the market, that's why we hold bonds. That's why we've held bonds in portfolios for those people who it's appropriate to hold bonds. But a few weeks ago, Brad, we were getting beat up on this. We had to do a couple of videos on our YouTube channel to talk about why you still hold bonds. Yeah. Now all of a sudden, no one's questioning that. Nobody's questioning why you hold bonds. This is why you hold bonds. There's a 10% chance of a war this year, according to most analysts that people would follow.
At the beginning of the year.
Yeah. And here we are.
Right.
Here we are.
When times are good, everybody wants to invest in equities and ride it. But when things get bad is what the biggest issue is.
Right.
It's amazing how our risk tolerance
changes. Yeah, exactly.
My Twitter is at Wiser Investor, and I put something out there a couple of days ago. I just kind of chuckled because there's a person that I occasionally talk to, but he was like, well, I hold a lot of cash in order to invest when the market falls. And then now that the market's fallen, Is any of that money going to work now? Oh no, it's too scary to invest in this environment. I have to wait for it to get higher
to rebound.
And we're not laughing with you, not at you, right? Kind of a thing, because that's human nature. And I feel the same way. I'm like, oh, I don't know if I put new money in now, but then the training, right, kicks in and my brain goes, hey, this is when you invest, is when no one else wants to buy anything. That's the good day to hop in, right?
Yeah, the odds are you're not going to time it perfectly, but as long as you are at the bottom, then close to the bottom, then that's worked out better than waiting for it to rebound.
True. We just don't know if we're close to the bottom.
Which brings up another point as to what benchmarks do for us. Okay, they don't just gauge the performance. They don't just help set the construction of the portfolio. They help us to manage it through periods like this. Because we know that a 60-40, 70-30 allocation has an expected return over the long period of time that includes events like what's happening today. It's already baked in to the expected return. So the benchmarks help us to manage the portfolio on an ongoing basis and keep us from jumping out of the market and into the market and out of the market and into the market, because we feel like that's the appropriate thing to do as an investor, not as a firm. But the benchmark helps to hold our feet to the fire, if I could use that term.
Well, there's some very basic things that we walk people through, and so it applies to anybody who's listening, is your portfolio cannot be the first place you go to in times of crisis. So if you have your own crisis, or I guess what's that saying? If there's it's a recession when your neighbor loses his job. It's a depression if you lose your job, right?
That's very good.
We're not in that environment right now, but it kind of applies. Sometimes it applies the same way with investing. But the three things. One is eliminate debt, right? If you don't have debt, that means you have less payments, which means it takes less cash flow to keep the boat afloat, right? Keep the plane flying. Second thing is you want to have emergency reserve set aside. And this is something that everyone talks about, but this is why you do it. This is why you have, typically, I recommend no less than $50,000 or 6 months worth of income that's sitting in cash, not earning anything, losing to inflation, all that fun stuff. Yes, that's right. It's sitting there because when you need it, its rate of return is 100%.
That's right. Yeah. That has been the number one question as prospects have come in, saying, what do I do with cash? And I think as a firm, we have that mentality, that stability, knowing that cash has a role in your life. Okay?
Right.
Yeah, you're not getting any interest on it, but nobody else is either. So it's not as if you're getting cheated somehow. Everybody's in this same situation. But the cash itself has a role. And I think you wrote a very good blog on this a while back, how cash still plays a role in our lives, even though we're not getting a lot of return that we used to see back when money market rates were 5-6%.
Well, if you're still working, think of this. If you lose your job and you have enough cash to wait out a new job that is the one you like and the one that pays the most, what's the rate of return on that cash? Very high.
Yeah.
So that's what it's there for. It's not there to make you wealthy. It's there to keep you safe. Then on the other, the third point is if you're withdrawing money in retirement from a portfolio, you keep 2 years of that need inside the portfolio in a cash-like instrument. You can do short-term treasuries there to have some fighting chance of a positive rate of return. But the point is that when the market's falling, you know that, especially when it's drastic, you know that that's money you'll never have to touch. It's way out there. If you're saving for retirement now, you're working still. You're buying more shares per dollar. So you should celebrate this. No one likes seeing the number drop, but yesterday we had an 800 point drop, right?
Right.
So we have a robo platform here called FlightPath. I logged into my FlightPath account and I threw $1,000 in. Why not pick some up when you have a bad day like this, right? So that's what you do. You throw a little extra in if you have some sitting on the sidelines when it's really bad days. Same way with your paycheck. I mean, if it gets really bad, maybe you front load your 401k for 2022 and max it out before before the rebound, right? So there's lots of opportunities that you can do to take advantage of the situation. If you're already retired, you're kind of along for the ride, but just know that if you don't have debt, if you don't have, and you do have your own personal reserve, then your portfolio has a reserve. You probably look at almost 3 years before you'd ever have to sell anything for a loss in the portfolio. 3 years, you pretty much get through anything in the past.
Right.
Even the 20s, you could hold out for 3 years, you were fine. Financial crisis, same way. So the point is that you have to set yourself up for success. What we see sometimes, we have people come in who have tremendous amounts of debt, no savings, and they want to start saving for retirement. And that's when we have to redirect them to like a Dave Ramsey Financial Peace course or just kind of coach them through. No, you got to eliminate the debt first. You build up your savings, then you invest. That allows you to have better behavior on the portfolio side.
Well, a lot of times you see it sitting in cash, earning, like we said, 0.5% on a good day, while they've got a 20% credit card. So that doesn't really add up.
No, it doesn't add up.
Yeah. From a financial planning stance, it's not just investing. Okay. That's the end. That's the result of all the work and implementing the plan to move forward. It's all about structuring our finances to, as you said, set yourself up for success, right? Yep. So you structure it in such a way that you lower your debt, you raise your cash reserve, you invest for the long term, okay? And you have it in tax qualified accounts that give you the best advantage for when you withdraw it, okay, in retirement. So,
well, and then on top of that, you do planning. And so the planning tells us that we know our clients can take a 20% hit in their portfolio plus another 7.5% hit the next year, still only average a 5.4% rate of return, and they still make it to age 95 without running out of money. And we know this because we've done the Monte Carlo simulations. We've run 1,000 different possibilities, and we know that they still have a high probability of success. So the financial planning is what goes on top. That's where we have a lot of new clients now coming out of other firms that have a good reputation, but they're asset managers. They're not planners. It's two separate things.
Right.
So when you have an event like this that's happening, we have confidence knowing that because of our planning, that our execution on the portfolio side is going to work out just fine. And our benchmark for them is whatever the plan is. The planned rate of return is what you referenced earlier. But if we're just going to be comparing like model efficiency, right? Because we could do a 5.4% rate of return average the rest of their life and they'll be fine. But did we build it the most efficient way? Right.
When you consider the risk. Okay?
Yes,
you
exactly.
Want to manage the risk as well.
That's where it goes back to VT
to.
and B&D.
Yeah.
That you can build your own benchmark and then compare that portfolio versus where you are now, and that gives you an idea of what you're supposed to be doing if you need to make changes or not. So, I think we covered this topic really well. Anything else you guys want to add?
Sounds good to me.
Invest for the long term. That's the key to success. And yes, there's going to be time periods where you want to maybe do some day trading and buy the hot stock that everyone's talking about, the water cooler. And you know what? Open up a Robinhood account, throw a few $1,000s in there, and go do that yourself. But your long term money, your life money, needs to have a plan, and it needs to be executed in a thought out manner. And you can benchmark that by simply using those couple of funds there. All right, guys, good conversation. Talk to you next time.
Thank you.
Great.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.